Ladies and gentlemen, this episode is probably one of the most fun episodes that I've ever done. It's so relevant to those of you that are in the co-living journey. This is Fernando, and Fernando is, in my opinion, one of the top lenders for co-living real estate in the United States right now. He closed 70 loans last year, co-living specific loans. So he pulls back the curtain on this episode on the vision for where this could go when it comes to lending, to the techniques and some tricks and some hacks that you can use to get this co-living home that's cash flowing, producing. We even go into raising capital and how Fernando bought 4 co-living homes using 0 of his own money while in debt, while not having good tax return, while unemployed. And no, I did not misspeak. And he still bought 4 co-living homes. This guy is a problem solver. He thinks about life and problems differently. He doesn't see challenges as negatives. He sees them as problems to overcome. You guys are in for a treat. This guy has done personal loans for me in the co-living space. He's always been a pleasure to work with. We have a partnership with him for our students that we work with him in our program. And I am just so excited to continue that partnership. And we are definitely going to do a part 2 to this episode. So let me stop ranting and raving about how awesome this was, and let's get into it and enjoy. And please let me know. I love to hear feedback from you guys. If you guys are enjoying this episode, share it with someone, spread the word about what we're trying to do and get to 1 million co-living units between myself and my community. That's what I want to create, and we can make a dent in affordable housing through that. And lending is a part of that. So get into this episode, take some notes, and enjoy.
So you asked me how I'm branding myself. This year I've closed over 70 co-living loans.
Is that right?
Damn, we've closed over 100 loans.
Yeah, but thanks, 70% of them.
So yes, exactly. So kind of, I think it's just because of the way we all make money, right? Like the biggest way to make money right now is co-living. Like people refinancing out of hard money loans, their end goal is to somehow do co-living, right? Like, so that's when I think about like how I'm branding myself. I'm very okay branding myself as like a co-living lender focus, Airbnb focus, the DSCR lenders. So I don't even do conventional anymore. So I don't do conventional, no FHA, none of that right now. I'm just like very heavily niched in DSCR, bank statement as well. If it's going to be in an LLC, like that's my niche. If we need to figure out ways to partner, get capital, private money, LLCs, DSCR, like Airbnb income, like getting very creative. That's my niche. I don't need every loan out there.
Yeah, no, dude, I love this. First of all, I'm incredibly impressed that you've closed over 70 co-living loans this year. I'd like to step out there and say that's probably the most. I mean, do you think anybody's closing more than you in the co-living space?
I don't know. I mean, if they are, then they're, yeah, I don't
feel
know.
Like if they were, I would know about them, dude. That's badass, man. That's so amazing. What's the hardest part? And I've got some questions for you. And again, what's the hardest part of doing co-living from a lending perspective right now in the marketplace as it is, here we are in October 2024?
Yeah, so I think it's let's say from a lender's, from like my job is that it's dynamically changing every month. And just in the past year, we've probably switched co-living, like who my preferential co-living lender is 6 times. And that's because some lenders are just closing up their shop. And so because it's so dynamic, it's always changing, and I have to like constantly be doing my own research and development and talking to different lenders and like trying to fit, like at what point would I introduce this lender versus a different one? So that's probably like from my job's perspective, the hardest thing. So for example, like in the beginning of this year, we used to be able to use co-living income, which was super cool. And then that lender dropped off, right? And another one, we were able to go 20% down and we would gross up market rents by 120%. So we can basically multiply the market rents by 1.2, and we could accept your master leases with entities, and then that lender fell off. And so now like we don't even have at the moment, I don't have a 20% down co-living product. I only got a 25% down and 30% down, right? If like I'm talking about true co-living, like accepting a master lease, LLC lease, like that's like, we don't have to hide what we're doing. I don't have a 20% down lender for that. if we want to go 20% down, we now have to mask exactly like what we're doing, right? Airbnb, AirDNA, regular long-term rents. Like you have to get more creative in how we go 20% down. And that could change, right? I'm expecting 2 other lenders on board, but before the end of the year, and they haven't released their terms yet. So just like that's probably the hardest part, is that we're doing a podcast two months ago, and that 20% down option was there, and then a month later it's not there anymore. I'm like, shoot, so that's probably the hardest part.
Right. What tell people a little bit about what's the difference between, it's a basic question, but dealing with you as a broker. Just I want you to define that versus a direct lender. Why is it better to deal with a broker versus a direct lender, or is a direct lender better? Like, give us your opinion on that. I mean, obviously, with what you just shared, with it changing so much, I think everybody's grateful you're not a direct lender and you only have one person you can lend with. So tell us a little bit about that and how you see that.
So a lot of it also comes down to like your time. The way I got started was because I became my own broker. A person like me, I felt like didn't exist at the time, where they were solving my problems faster than I needed them solved. And so then I started just reaching out to a bunch of direct lenders and like trying to solve my own problem. I had to do my own cash out refis on a 9-bedroom, 3-bath pad split or something, right? And nobody was out there telling me, oh, these are all the different ways you could do it. So I had to do it. This was before I became a broker. And then I solved it for myself and for my friends.
You had a home? Is that what you're saying? Or you were trying to solve this problem for one of your clients?
No. Dude, I just got licensed. I have only been a broker for a year and a half. So before that, I've been an investor for 4 years.
You were an investor.
I was an investor.
Okay, got it.
Right. So what I'm saying is that, like, if you're an investor out there and you felt like you've had to solve your own problems, then maybe you don't need a broker, right? Because you're figuring out your own R&D to solve your own problems in your own way. And then if your time is still worth it for you to continue to solve your own problems, then you don't need a broker necessarily. Like the broker becomes very valuable when you don't have the time to solve your own problems. Right. And so we were just talking about how to solve the problem of going 20% down. Right. Or how to get like certain credits, or like there's all these, there's solving the problem. I think you're more than capable of solving your own problem, but I think that you'd maybe value your time a little too much, in a good way, where you're like, dude, I just need somebody who's as good as me or better that can solve the problems that I need solved at the time I need them solved. Right. And so you're not out there like you go to take it to one lender.
I was just going to say, I think you're giving people way too much credit, man. I think you think differently than a lot of other people. You went out, you solved your own problem, but I think there's a lot of people, even me. I mean, I do value my time but I think I'd be like, I just need to find someone else. I don't even know. Like, I don't know your world. Right. Like, so the fact that you dove in, learned a whole new world, you were an investor, you learned a whole new world. And you kind of turned that around, man, which I think is really cool. You turned that around and said, now I'm going to help other people do it. That brings you here to this podcast. That brings you to closing over 70 loans last year for people who are trying to get into a niche, new, up and coming asset class that's truly solving a big problem in America. Like, I just want to commend you for that. But I think you giving me and a bunch, like, I think we want someone like you that's like, hey, I can now help you. But anyway, that was a little bit of a tangent. I just wanted to reflect to you that I think you're unique. I think you're special. And I don't think, you have a really cool, I've noticed in working with you now, and I think it's fine to say this publicly on this podcast, that like you and I have closed several loans together. We have plans to close several more together. And I refer you out, and I don't make any money by referring you out. And I like to say that because I want people to know that I'm not making money by referring you out. I just am referring you because I think you're awesome. And I think you're doing really, really, really cool stuff in the co-living space. But I think you're also coming in as that who for a lot of people, right? And helping solve that problem. But please continue, because I actually didn't know this part of your story. So you start as an investor, you solve this problem, you start solving this for other people. Just I didn't mean to fully interrupt.
No, you're good. So yeah, I started as an investor, so all 4 of my co-living properties, I never used any of my own money, and I was unemployed and I was in debt. Like literally every reason why people would say I can't do it is like all the reasons why I said, what if I could? And I needed to find lending options to do that. I had good credit. So the benefit that I had was I did have good credit. I protected my credit at all times, but I had left my W-2 job and I was like, okay, well, I got to figure out a way to make money out there. And you know what they say, like no job, my tax returns were dookie. I did have credit utilization, right? Like there was all this, I didn't have any money, right? I had liquidated my 401k to survive. I was living with my parents. I wasn't married at the time, no kids. And I just started like paying for masterminds. I started learning the skill. And I thought if I learn the skill, then I should be able to figure out a way to make money. Like, I don't know how I'm going to do it, but if I learn the skill of investing, then like good things may happen. And that's what happened. So my first investor was my girlfriend, who became my wife. I had the crazy idea and she had the money. And then so we bought our first house out of state, sight unseen. Fun. And I just want people to know, like, we launched it took us 9 months to buy our first property. So it did take a while to learn concepts. We launched and the bottom floor flooded. And
this was supposed to be like a pad split co-living type home?
Yes, exactly. And like, we had never seen the property. It was bought sight unseen. We trusted the people, and not that anything was bad or we made the mistake as the investor, but think about like our parents who were like, how are you not going to see this home before you buy it? And like, think about all of our friends that are like, you just put all your savings. Me, this girl just trusted her life savings in my idea, and the freaking bottom floor flooded. So like, everything that can go wrong may go wrong, right? So that was our first one.
Did she marry you to recoup her investment, or was that? No,
that was exactly it. Yeah,
that says something about you and your character that she still married you after that. That's amazing.
Still ended.
So how did that story end? So you buy this property, sight unseen, bottom floor floods. How did that end?
Oh man. And so then now it delayed our launch, right? We had to then fork up more money to like fix up the house. The people that had moved in ended up having to like either adjust to the top floor or they had to move out. And then within the next month or two, we fired our property manager because we're like, oh shoot, that was a blessing, I guess, because we saw that they could not handle this type of management that was co-living, which I'm sure you talk about, right? Like the regular property managers out there that are used to responding to things once or twice a year, like this isn't for them. And I'm sure you talk about that all the time, right?
Yeah, but no, please reinforce that. So what did you do? Let's go down that rabbit hole for a second. So you had just like a normal property manager and you were trying to kind of like coach them into co-living. Was that what it was? Or how did you find that?
They were introduced to us by a real estate agent. And at the time, I think they were a property manager that were trying to break into the co-living space. And because they were old, they had been around for a long time. And so for us at the time, I thought I valued, experience in the sense of like, just they had a lot of time in the world as a business. So I thought that's what I valued, not understanding that what I should have valued is how good are you at solving this problem? And so then we learned very quickly that they weren't a good fit. And I think they learned very quickly as well that they don't want to manage co-living properties because they stopped offering that as a service. And that was a big learning lesson. So we switched it was basically a couple that they started their own property management company after managing their own, co-living homes, which is, I absolutely love. Like, I think those are the best co-living property managers, the ones that had to solve the problem for themselves. And they were great too, so that's kind of how we switched, and they already were solving problems for themselves.
Man, that's great. So your girlfriend invests the cash for your first one. I'm still very inspired. We've known each other for a little while now, and I did not know this part of your story. So this is fascinating for me. So your girlfriend invests in your first one. You have no job. You have good credit. It's the one thing in your name. You got no job. Your tax returns are wonky. You have no cash. You're in debt. And you buy your first property. So badass. So impressive that those things didn't get in your head as limiting beliefs, because you and I probably hear them all the time. Well, I can't invest in real estate because I blank, right?
Yep.
So tell me let's just go on the journey here for a moment of property 2, 3, and 4. Did you like throw up a Facebook post and get people to throw money at you? Like, I'm actually genuinely curious. And I know we have people listening here that want to get to a place. Maybe they are using their own capital for now, but they want to get to a place where they're raising capital. What'd you do?
So after I got my first one, I was like, oh, it's pretty cool. But I was still intimidated that it may not work because also the people that I'm talking to, what I realized is like, they have to be able to stomach the problems. You know what I mean? Like, and that's a real thing, like, cause you're going about your life, you're in Africa and you're traveling, right? And like, there's problems. There are problems happening. Can you stomach that? So anyway, so I started to share just with friends and family, like, hey, this is what we're doing. These are the problems that happen. I was super transparent because if anybody was going to be joining me, I needed to know that they can stomach problems. So I just started sharing the worst parts of everything. I would try to sell people out of investing with me. And if they still wanted to invest, perfect. So,
I love this strategy, dude.
Yeah. So I told my brother, and then it made me like super deflective from this, from feeling like I had to make any sale because I would just share the worst possible things and people would sell themselves into it. So I told my brother about it, told my friends, and my brother got his own because he's my brother and I was helping him out. And I was like, okay, if I could help him out, I developed the skill. I don't need equity or nothing. So I helped my brother do it. One of my best friends, I helped him do it too. He bought 2 co-living homes. I started just like helping people. And then I started to more so develop the skill. So over time, I would say that the people that are doing it, if you're not comfortable asking for money yet, then just go do it for free. Because you're gonna build the confidence of just helping the people you care about. And that was it. I helped my brother and his wife get into a home. I didn't need their, you know what I mean? Like I just wanted to develop the skill. And I started to build my confidence and share my journey. That was huge. Started to share my journey, share like how I was helping other people do it. And then after I helped a few people get into their own, I'm like, okay, a year or so have passed. I was like, I think I'm ready for a partnership. So then my wife's parents became our first, like we used their HELOC. They became our first private money lenders. And now my wife and I were married. We got married. She decided to stick around. And so I was like, all right, cool. And so we used 15% down, her conventional like income and all that to qualify. The second one, we used her 10% down option, right? Vacation home loan. And then we got a gift from her parents out of their HELOC to buy, right? So gifting is always a huge benefit. And then now we're obviously paying back that HELOC. The third one is a pretty crazy story because I started to just share this online. I just started to share what we're doing. No expectation. Remember, I'm sharing the ups and I'm sharing the downs. So the insecurities that you have to tackle when you're sharing the downs, like you have to share the downs. For anybody who wants to battle their mindset, you have to share your losses. Because in those losses, I built my confidence in my losses. I built like overcoming the insecurities by sharing my losses. That's it. You have to share that. And that's where the trust is built. The trust is built with everybody who sees that I've shared my losses. So I'm sharing all this stuff, right? 6 months later, I got a private money lender. And 5 days before we're about to close, they call me. This is a crazy story, by the way, that the sister of the private money lender calls me and says, hey, I'm getting a divorce and my brother needs to give me this money. So he's backing out of the deal. And in my head, I'm like, all right, this just sounds like a pretty like wild sister who doesn't want the brother to make an investment. I'm not here to force people to do anything. But my wife had told me, babe, do not send your own earnest money. Like if the PML says they're in, have them send their private money. But I'm like, no, he gave me his word. Like I'll send my EMD in. Again, 5 days before closing, he pulls out. I'm about to lose $5,000 EMD. And again, you can like sulk and you can cry and you can whine and you can complain and you can go to court. But I'm like, all right, Fernando, you've been posting for 6 months. Just put it out there that you need money. And so then I put it out there. I'm like, hey, my private money lender backed out. I just put it up on Instagram. Just like you said, I just put up a post. I had 2,500 followers at the time. One person reached out to me And it was a person that had just started following me 6 months ago.
What did that post say approximately? Like, not the perfect words, but was it just like, need money ASAP? Like, how did you pitch this on social? I'm genuinely curious.
Yeah, it was just like, hey, we've been investing in Pad Split for the last few years, whatever. This is how our properties have been performing. We have an opportunity to invest right now. And anybody who's interested, like, ping me because the spot just opened up or something, right? And it was something super simple. And again, it was just like a Hail Mary. I was like, all right, I might as well try. And I hadn't asked of my network for anything for 6 months or more. So it was like, what do I have to lose? And then this girl responds, and I can't believe it. We got on a call. She wires me whatever. In total, we needed like $96,000, and she came up with the money. I didn't need all 96 at that time. I think she had us to close. We probably needed like 60 or 70 or something like that, right? Then you have to rehab. But still, like, the next day, pretty much she wired the money into title. I had sold my pitch, and I'm like, why did you trust me? I've never met her before. I've never seen her. To this day, I still have not seen her in person, right? I said, why did you trust me? And she said, well, you just been sharing your journey for the last 6 months. And, I share about my wife, and like we're having a kid. I'm sharing like personal stuff too. Again, like the losses. She felt like she trusted me enough to partner up. So that was how I got my third deal, dude. And just this random person from Instagram. And then the fourth one was my best friend.
Yeah. Before we go into the fourth one, let me share something. I mean, I think there's a lot of power in that story. I don't want to gloss over it. It's a beautiful story. I think there's a lot of power in here. One of the things that I preach to my community is to dig your well before you're thirsty. It's kind of the little saying we use. And I guess what that means to me is kind of what you're saying. You're putting the word out. You're building relationships in advance, right? And so I guess my question for you is how much. I mean, you practically already answered this. She basically told you, like, hey, the reason I'm investing in you is because you've been sharing before this, right? So that all of that work that you did to create who you are, put who you are out there, share about Pad Split. It wasn't like this is the first time. It wasn't like a weird post because people have been hearing about you investing in real estate. It wasn't odd. So I always tell people, like, I don't care if you have an email list, like send an email list, like send an update. If that's all you have and you have notes, because I'll get these people, I'll be like, I don't have social, right? These older people. I'm like, cool. You got emails? Great. Like send out an update once a month. And just keep these relationships going so that if you need money, when you need money, if that opportunity is ever there, it's there. It's just there. And man, you demonstrated that so well. I would like to ask you about one thing that you said though, because I think it's important. You mentioned gifting. Like getting the down payment as a gift. Would you just talk about that? Before we go into the fourth property, would you just talk about that just for a second as a lender, what that means, what that looks like, how you can use that from a lender's perspective?
Yeah. So when I work with an investor, I'm usually asking them, what's the source of your down payment? And depending on that answer I'm going to have different solutions. So if it is a conventional product that we're looking to use and, okay, I'm going to say these terms. I'm going to share some stuff, and just know I'm a good person. All right, everybody, we just have to we have to get creative at times. All right, so I just need to preface with that too. I'm not here to share shady stuff. I'm here to like just share like how to get deals done. Within the parameters of the financing world. Okay, I just need to preface that. So that way when we share these next pieces, like number one, yes, if it's a conventional loan, they want to see that the money's been inside of your account for 2 months. Methods of getting around that is gifts from family members, closely related, right? So your parents, your brother, your siblings, things like that. Here's the crazy part. Okay, again, I'm just going to share the rules. All right, let people's minds do whatever they want with it. We, as in like the lender and title, like we don't ask where the money came from if the family member is sending the money into title directly at closing. This is a gift. It blows my mind. We literally do not ask for the bank statement of the gift donor. We don't ask them for that. As long as the money goes into title. Okay. If the money goes from the donor to your bank account, don't do that. But that's when we do ask. We have to ask them for their bank statement. Okay. So if you're reading between the lines here, we're not going to ask your donor, right? The person giving the gift, where the money came from, if the money just goes directly into title. So, okay, that's a solution there, right? That in terms of getting the capital, like if the money came from a HELOC or from whatever, right? I'm just saying that's the guideline there. All right. Now, if somebody says, okay, well, I don't have a family member, I don't trust any, like there's all these different trusts. And so we have a different problem to solve, which is like, I just need money from this person. And I said, okay, well, number one, are they going to be a partner or are they just going to be a private money lender? And if the answer is like, oh, they're going to be a partner. Okay, well, that's easy. Then we can just have them wire it directly to title. They're in the LLC. That's an easy one. They say, oh, they're not a partner. They're just a private money lender. Okay, so two ways. One, we have them fund the LLC, right? And then we use a lender that does not have a seasoning period or a very small seasoning period. Seasoning meaning like how long does the money need to be in the bank account for before I have to ask them where the money came from. Okay, we have lenders where if the money's there right when we submit the loan, I'm not going to ask you where the money came from. So that's in a specific lenders, again, their rules and guidelines, which is different than the conventional rules. So there's different lenders we use when I need to solve a problem. This is part of that benefit of having a broker, is that if you were to take that problem to just one lender, the lender's going to deny you. They're going to say, well, we can't use that money. All right. But if you took it to me, I'm going to tell you which lender will allow you, right? Which lender will allow you to use money from other people that are not connected to the deal or the LLC itself.
Powerful. Yeah, amazing. Cool. I just wanted to riff on that for a second. Very well explained. What I'm taking away from this, outside of the details of what you're sharing, is, and man, I've experienced this with you, even in my own loans with you, is just how creative, right? Like, I think you approach problems with how can I get this done versus can it be done or not? And that small switch in how the question is asked, and again, correct me if I'm wrong, this is just my experience of you. And I think if more people were to ask the question of how I can get it done versus can it be done, means the world, means deals closing or not closing, means our brains go to a different place. It means your brain goes to a different place to solve problems for people. So very powerful. All right, let's circle around. I want to talk about the fourth deal, just because like my brain is still on that, so I can't let that one go yet. 1, 2, and 3, those were crazy stories. How do we get to the fourth one?
Yeah, so the fourth one, and the third and the fourth one were basically I did the burst strategy, where I did the buy, rehabbed it into a co-living home. The third and fourth deal we bought around the same time, and this is when again I'm my own guinea pig. So the third deal, I did not convert it to co-living, and then I did the refi. The fourth deal, I did convert it to co-living, and then I did the refi. And at the time, remember, I was still testing lenders. Like I was my own guinea pig. Am I going to be able to do a refi when it's a 9-bedroom, 3-bath? I don't know. Let's see what happens. Like worst case scenario, I got to tear down these walls or something, right? But I took that risk on myself when I was testing lenders. So how did I do that fourth deal? I had built my list of, I started to build my list of potential partners, right? Getting on calls with people, like, asking, hey, like, can I just share with you how things are going? People that have shown interest. Yeah, I'll share with you how the numbers are. We hop on a Zoom call. I'm sharing my screen. I'm showing them how the numbers are. I'm just being very transparent, right? And then I start to get like a list of people. I'm like, okay, they're possibly interested. They're possibly interested. And I start to stack up the people that I think would be a good partner. And it was kind of cool because then in my head, I already started to associate like, oh, okay, this property can go to this person, this partnership, so on and so forth. This was when rates were just starting to go up. And my goal was to get to 10 properties in a year. And I had bought 3 in a year. And again, the goal was to get to 10. But in 2022, rates spiked up. And I stopped buying because by the time I did my refi, right? The rates had basically gone from 6% to 8%. You know, like our first we bought in the beginning of 2022 and we had like a 5% interest rate. And then by the time we refinanced my third and fourth property, I was at an 8%. And your numbers drastically change, right? For what your cash flow and all that stuff. So I kind of pushed pause because I thought it was going to be irresponsible of me to continue to buy when I wasn't even aware how these properties are going to perform or what the market would do. So I kind of pushed pause, but I didn't stop building my Rolodex of investors, right? That's what I continued to build. And even right now, like if I wanted to buy, we can talk we can talk about this too, but if I wanted to buy, in my head, I already have a list of who I would reach out to. And I have an idea of how I would pitch it in a way, right? And I have just some more experience of how to structure partnership deals, things like that. But yeah, that's how I did my fourth one. My fourth one was a best friend.
I love it, man. I think, thank you for going so detailed on that. Thank you for sharing some of the little secret sauces of all of that. I think there's so many valuable lessons in raising capital from what you just shared, in building relationships from what you just shared. And frankly, man, I'm taking a big lesson away from just like how important it is to share your losses, right? I'm a coach in the co-living space. And so obviously I want this space to look great, and it is great. But you also take some punches to the balls, to the gut, whatever you want to like. You also take some hits, and that's a really great lesson. I want to learn, and I want to do better at. I even thought of like my property management company went through a real rough time the last like 6 to 12 months. We just grew so fast. I didn't have the team or the infrastructure, and I frankly was kind of ignoring it. I was like off building a coaching company, and so I just thought I just want to share this because I want to share what you've inspired me to do. I'm inspired to get with my COO and do an episode on just like all the crap we just went through over the last 6 months in our property management company that frankly is insecure for me to share because I'm like the guy who's supposed to have it all together, right? Like, and I'm like, no, right. We were like at a crazy vacancy rate. We just had to fire half the team. Like it was very bad, right? And we've turned a corner, but I think there's a big episode, and I think all the lessons, the gems are right there. So anyway, not to go off on that tangent too much, but you inspired me to do that. I made a note of that.
No, dude, that's beautiful. That means a lot that you even shared that right now. So I mean, dude, I think that's respectable, like big time. Like who your character is, so much of your character is defined in the losses, not the wins. And so when I think people are investing in you, you know, right now, dude, you just to share that shows a lot about your character, who you are, which is good.
Brother, I appreciate that.
So I'm happy to be here. Thank you.
Yes. So I want to get into some of the details of. I want you to tell me when co-living first came out. Well, let me back up. Why co-living? Why didn't you buy just some freaking long-term rental? Like, how did you even get into that in the first place? Again, curious question. Like, why were you not buying multifamily or single family, or why were you not buying Airbnbs? Like, talk to me about that a little bit.
Oh man, yeah, you're right. This is a good one. So this is good because I've dedicated so much time into answering that question. So, first of all, when you analyze the deal as a long-term rental, you know, you're maybe going to make $100 or $200 or $300, right? But for the amount of money you're pouring into it, your ROI is not really there. So unless you have like a consistent stream of capital that you don't need the cash flow, and somebody that has a lot of money that just needs to pour into assets may not have to do co-living if they don't want to solve the problem of co-living, because co-living is a problem to solve. And so some people don't want to put in, like, they don't want to think about the property management or how do I find tenants and how do I manage that, right? So first off, I needed to find out who is this not for? Because by answering who it's not for, then I can understand why people wouldn't make this decision. And that's when I started to talk to different private money lenders or partnerships. I started to understand that. I'm like, okay, this is who it's not for. So the people that like don't need the cash flow, then they're like, okay, that's cool, $1,000, but $1,000 not going to change my life. Like if I'm making another $1,000, $2,000 a month, like, yeah, yeah, it's not really worth it for me. And in my head, I'm like, okay, wow, that was a huge eye opener for me, because that is a lot of money to me. If I'm making an extra $1,000 to $2,000 a month, like that is life changing. So it was really clear to when I pitched it to the people that I thought would love it, and they told me why it wasn't. I was like, okay, that's interesting. So to answer the question, like, why not just do multifamily or regular long-term rental? And it was because I needed the cash flow, right? 65, 70, $80,000, I don't have a lot of. And I don't know a lot of people that have a lot of that type of money. So I really needed to make an impact with the money that was spent. My return on investment needed to be high enough to warrant that it's okay to spend this much money. So if you're putting $80,000 into a deal, like, can I still get a 15, 20% return on that money? Because that's what made it impactful. And that was hard to find anywhere else. Yes, I'm not going to say we couldn't have found it in Airbnb. This was during COVID, right? Like right when COVID was starting. So my wife and I decided, do I believe that I can hedge against COVID and evictions with Airbnb or with CoLiving? And for me, I saw CoLiving as a necessity. People are living in a CoLiving environment out of a necessity, not out of a desire or of a luxury per se. So that was a big one where I thought, in a down market, do I think Airbnb would go down, or do I think CoLiving would go down? And I thought Airbnb would go down. So that's why I also plugged into CoLiving. And during COVID, we only had like 1 or 2 evictions across, over 20 rooms. So now we have 34 rooms. So it's been good, yes, there are problems and we're solving those problems, but I'm very okay with CoLiving in the long run, right? In the long run of like, this is going to withstand the test of time.
You said, hey, I need like 80 grand is a lot. Like, I need to make sure if I'm going to spend 80 grand into something that it warrants spending the money. And I would even just add on to that, because you've been so creative with your financing. You've gotten other people to finance these deals. You also need, now, if you're raising the capital for the deal, you're in essence financing 100% of your co-living deal. You need a return that's great enough to pay 2 loans, right? Like the main loan, the 80% that you get, and then the other loan. And so again, how crazy and how cool it is that you found an asset class that we both found an asset class. This is why you're on the podcast, this is why we're connecting and why we've connected to like that can pay 2 loans and still have some cash flow. That's insane. That's crazy. That's amazing. So anyway, you were going to say something else. I want to pass it back over to you.
No, just that, like, I ran the numbers. Like, I knew people buying, true multifamily, 4-plexes, 5-plexes, 6-plexes. And I'm like, okay, but like, what's your cash flow? And their cash flow wasn't even as good as like a single family home that's converted. I was thinking like, okay, wait, I'm spending half the amount of money you are, and I'm making the same amount of cash flow or more. I'm still going to stay in what I'm doing right now. I'm still going to stay in this, single family home conversion to co-living, because I guess I don't need like this massive appreciation. Maybe that people buying multifamily are thinking, oh, okay, but it's an appreciation play. Some benefits are that when you buy multifamily, you can buy it low and then you can rehab it and you can get the rents up. And then in a few years you could sell it. Cool. That's a different strategy, right? Than a different mindset and approach. And I think people make a lot of money in that way as well, but they don't need the money today. And I think for me, I was like, okay, I need the money more like today. Can I get to $5,000 or $10,000 of monthly active cash flow? How fast can I do that? And I think there's in a portfolio, like I said, there's still value in people investing in multifamily and then exiting in a few years and selling for multiples or something, right? Like I think there's value in that too. I'm not saying that you're not going to make money in that area, but when I chose co-living, it was because I could cash flow the same or more than a multifamily with less the investment.
Yeah. I remember having a similar experience, man. I had a buddy buying an 8-unit, and it was like an 8-unit multifamily. And he was bragging about it on social. And I remember like having this pinch of jealousy, like, man, like, cause I've never bought I've never bought a multifamily ever. And it's a harder space to get into a lot too, because it's very competitive, right? There's a lot of big money floating around in the multifamily space. And I remember kind of having this thought of like, man, maybe I should like switch it. This was maybe when I had 3 or 4 homes. And so same thing. I went, wait a second. But then I just had that mindset shift of, wait a second, I'm actually doing that. And here's how my brain wrapped around it. I thought, that mofo's got 8 refrigerators. I've got 2. He's got 8 HVAC units. I've got 2. He's got 8 things. And that was how I was like, he's actually got so much more. And you're exactly right. My cash flow was similar, if not better than he was. And he paid a significant portion of money for this big old multifamily. And I was like, I'm doing 8-bedroom homes. Like I'm doing the same thing, just with less. That's powerful.
Exactly.
I'd love to get into a little bit, kind of 2 more big subjects that I want to kind of walk us through. One, I'd like to get into a little bit of the details of a DSCR loan around a co-living building, because I think, and here's kind of how I envision this going down. I want you to tell me all the problems there are with underwriting with underwriting a co-living deal. We've talked about one already. We've talked about how do you find the money for the down payment, right? That's a problem. How do we get it to debt service? I'd like to talk about that a little bit, right? And maybe just like, what are the other problems you see and how have you creatively solved those? Because you started a few years ago, man. And so a few years ago, there was even less visibility into this asset class, like multiple rooms, like what? Like now we're starting to see a little bit more adoption. You got the Pace Morbies behind this, talking about it. Now the investor community is starting to catch on. But I want to know about that. And then I just want to talk a little bit, we'll kind of end with like just talking a little bit about your vision for your company, how people can connect with you, and where you want to go with all of this. Again, selfishly, I'm curious because I want to know about that. But let's talk about like a traditional, like the way most people finance a co-living home is through a debt service loan. But there are other types of loans that people can use, right? They can house hack, they can use their 10% down. You want to talk about that for a moment?
Yeah. So let me touch on the problem of when the property structure, the type of loans dependent on the property structure. Because, I do get calls and people are like, oh, I want to buy a 10-bedroom, 4-bath home with a conventional loan. And I'm like, ooh, these are a few reasons why that may not work. And so I think having this conversation, especially if people are looking to refinance in a few years, right? Like what challenges may they face and how do they overcome those problems? So the two things, the biggest problems, number one is the property layout and the structure. So we're going to assume that you're converting all livable square footage into some type of room. So that could be the living room, the dining room, a sunroom, an office room. So you're converting these additional square footage so that you're probably left with only the kitchen and the washer room, right? That's probably the only true communal space that's left aside from the bathrooms. And in that situation, conventional lenders, they have to think about the buyers of the loan. So we're going to talk about the secondary market, right? Where I'm a broker. So I bring a lender and a investor or borrower together, right? And I broker this loan, but the lender is going to resell that loan. Most of the time they're going to resell it to another buyer. That buyer has their own rules and regulations for the type of loan that they will purchase. Okay. And so if they see appraisals and they actually have their own like AI auditing software that sifts through appraisals. So we were trying to like slide a lot of these types of loans through that had these converted areas. Remember I was telling you how we switched lenders like 6 times in the past year? Because we were getting very creative with appraisers and lenders and like trying to still do the loans, even though it had these converted spaces. And we've got a lot of them through, but then eventually the people that were buying those loans, they stopped buying them. And the lenders could no longer sell the loans. And it was because of these converted spaces. So that's the biggest problem that people are going to find is that if they can visibly see that a converted space is being used as a room, you may get lucky, but most of the time One, the appraiser is going to reject it. The appraiser is going to walk in and be like, whoa, what kind of house is this? This is a rooming house. This is a boarding house. This is an assisted living facility, an adult care home. Like, there's all these things that an appraiser who is not aware of co-living, they're going to just reject the appraisal completely. So that was number one, was the appraisal. We started to work with lenders that allowed us to suggest our own appraiser panel. And you know, we talk about this too. So when I enter a new city, I can actually suggest and I can build my own appraiser panel around co-living in a specific market. And the lender legally, right, legitimately and legally can pick from within the panel. So it's one of the coolest hacks I think that we have as a broker.
Yeah, man. Before you told me this, I had no clue. Like, the first thing that came to my mind was like massive conflict of interest. But then you were like, no, it's legal and they allow me to do it.
Yeah. And they allow us to do it.
And I can say personally that hack and helping people understand what we're actually doing, you know, probably, I'm not saying this as a claim of that this will happen to anybody else, but I know for a fact that on one of our deals together, it resulted in a better appraisal, like significantly better. So yeah, I'm just doubling down on what you're saying, like an amazing hack that blew my mind when you told me you could do that. And we were able to go out into the marketplace and find someone and share with them a little bit about what we're trying to accomplish with these homes, and then for them to get it, right?
Yep. So, and just to touch on that too, where like most people, the only time it's a true conflict of interest, which is the problems that were happening back in 2008 and all this, is one, if I try to influence them in any way. So if I'm saying, hey, I'm not going to give you this appraisal unless you give me like this value, right? Like that's sketch, right? So if I try to make them create numbers that don't exist in the marketplace, that's sketch. Right. So just suggesting an appraiser to a panel, right? If I'm not influencing them, and you can share comps, like anybody can share comps with an appraiser. There's nothing wrong with sending an appraiser comps because you're just sharing what you believe the market is saying, right? And the appraiser, sometimes the appraiser is like, those comps aren't valid because the square footage isn't right, or, you know, whatever the reason is, right? And sometimes they do accept the other comps. And so I always suggest even if it's a conventional refi or conventional purchase, if you want certain comps to be considered, it's not illegal to send those comps, especially as a borrower, to the appraiser and say, hey, would you consider these comps? There's nothing wrong with that because it's just the data. You're just saying this is other data that exists. Would you consider these? And the appraiser still has to do their job. They still have to say like no or yes, you know, so that's really it. And so, yeah.
And you and I have sent comps to several people on several deals, and they've come back and been like, yeah, no.
Exactly.
like those don't apply because of this reason, and this reason. And we just have to take it.
And I'm totally, exactly. And I'm okay with that too, because that is like, you are doing your job as an appraiser, and I respect it. That's it. And we just have to, you got to take the information and keep rolling with it. So that's a big one. So when it comes to nowadays, when it comes to doing a co-living loan, you know, you do have to, it's either you go to lenders that are totally no co-living, totally cool with, you know, a lease to an entity, right? You're going to have different LTVs hits or different interest rates. Versus like if your property is not a co-living property to the extent where it's like a 5, 6, 7, 8, 9, 10 bedroom home, and it's maybe just like a 4, 5, or even a 6 bedroom. Actually, a lot of 6 bedrooms could still pass as a long-term rental. Well, then we're going to take it either regular long-term rental, if it can pass long-term rental, or we're going to take it using AirDNA, right? And if we can tackle it, you know, going one of those two methods where we're using AirDNA income or we're using the long-term rents as income, then that's how we're going to approach it first. That's how I would always approach it. And then only if we have to absolutely try to take it co-living, where it's like a 7 bedroom, an 8 bedroom, or a 10 bedroom home, then that's a different problem to solve.
Yeah. And just in case anybody doesn't know, AirDNA is just a website that kind of aggregates data on how much an Airbnb would make. And there are lenders out there that will take that data in order to, you know, underwrite this loan. Do you think, man, and are you a part of Are you a part of any movement? I feel like I've heard that you are, and maybe I misheard, but are you a part of any movement to create some data, almost like AirDNA did for Airbnb, but some data around co-living income where we could start having like real co-living data? Is that a thing? Do you see that coming? Talk to me about that.
So we used to be able to use true co-living data, right? Earlier this year.
But where was that coming from though? Like where were they getting
from PadSplit?
It was coming from PadSplit, who is aggregating like income on homes and things like that. Okay, interesting.
But we probably did 20 plus loans using PadSplit data. It was the coolest thing in the world. I like thought I was like figured out. I was a man, dude. I was like, we use PadSplit income on refis. We're doing 80% cash out refis, and just like, dude, it was insane using this like $6,000 of income where normally it's like $2,000, and I was just living on top of the world. But although admittedly, I was like, I don't know how long this is going to last for, because this is what happened. Somebody has to be responsible for the data, right? And PadSplit's data did not distinguish between a multifamily home and a single family home. They didn't distinguish in their data between the two. So why is that a problem? It's a problem because if I go and get financing for a home and I'm saying this is an 8-bedroom, but an 8-bedroom duplex is different than an 8-bedroom fourplex, which is different than an 8-bedroom single family home. But to PadSplit, it's all the same, right? So that was the problem, is that the lender was basing their decisions off of this data that PadSplit was providing, but PadSplit didn't have their data refined to, that's an 8-bedroom single family home or it's an 8-bedroom duplex. So that affected how the lender was, so they basically rejected it and said, hey, we can't trust this data anymore. Once they saw a flaw in the data, they said, you just gave us single family home rental comps, but that's a multifamily. Right, and it's like, boom, they cut the program after that. I was like, oh, dang it, brutal. So
that's brutal. Really, please tell me PadSplit adjusted and is now like separating that out.
I don't know. You're right. I did tell him about that problem. You're right. I guess you're right. I need to find out.
Atticus, if you're listening to this, please make that adjustment ASAP. Please retroactively make that adjustment. Like, that'd be worth someone going back in and like sparsing all of that out, dude.
Right. That's true. I can imagine how much work it could be, but I think it's worth it, because that's going to help lending in the future so that it's trustworthy. Like AirDNA is trustworthy to lenders because Airbnb has done a really good job of preparing their data for lenders. And I thought that's super valuable. So if anybody goes to airdna.co, then
and pull out the right info. At the same time, I mean, I'll play devil's advocate on this point a little bit. Like AirDNA data, it also is. I mean, I have Airbnbs. I think we have 8 right now, and like it's Airbnb. Like one thing can happen and it's gone, right? Like all of my it's October 7th, 2024. Western North Carolina, Asheville just got destroyed by a hurricane, and I have 7 Airbnbs there. It's all gone, right? Like,
no, oh my goodness!
All the reservations are gone, like every single one, pretty much for the next 6 months. Like, so my point in saying that is, like, I've also seen AirDNA data and been like, "There's no way." Or you change a bedroom, you change one bedroom, and I get that they've done a good job preparing that for lenders, and I think that's the smart superpower that they've done is they've tailored it to what all the data guys want to see. But I'm on the operations side, and I'm like, hey, it's not always accurate, guys. But anyway, let's not go down that rabbit hole. I think your point is well taken in that we need that for PadSplit. We need that for co-living. That's the point you're trying to make, because we need to be able to get loans.
Yeah, and just to state something there too, like Dallas, Texas doesn't allow Airbnbs anymore, and like there's certain rules and restrictions, right? For Dallas, Atlanta, you can only own 2 Airbnbs in Atlanta, Georgia, right? Like they also have a restriction in Anaheim, over here, Anaheim, California, where I'm from. That's where Disneyland is. You need like a certain permit and all this stuff. Some lenders that I work with, they don't even factor that into account. So if somebody wanted to buy, an Airbnb, quote unquote Airbnb, like I'm not going to ask you for permits, which is also kind of blows my mind, because I'm like, wait. The lender is aware, and I'll tell them like, hey guys, like, do we need an active permit on this property for me buying it? And they're like, oh no, like you're fine. I'm like, yeah, all right, like that's cool. So yeah, it's just sometimes I get the permit question as well.
Yeah, I want to ask this question, man. I have a friend that runs a company in St. Pete, and he bought a home. He converted it to co-living. He, I think, don't quote me exactly, but I think what he ended up doing is he held it for 12 months. So he had 12 months of rental history on it. And obviously the income was great. Cause he was operating it really well. It was solid. It was awesome. I think it was like a home and an ADU in St. Pete. Then he finds this like mini hedge fund. It was like a group of doctors, and this group of doctors wanted to buy high cash flowing assets, and they were willing to be creative. He bought this home, I think, and again, don't quote me on the exact numbers, but I'm kind of painting the general picture. I think they bought it for like $350, put like 100 into, maybe 100 or 150 into. So they're in for $5. They sell it. They write it under contract to this guy for $1 million. And maybe I think it was 1.1 was the actual purchase price. You think, okay. And by the way, it was like within a year and like it wasn't like all of that was appreciation. This hedge fund goes to a local bank, pays $2,000 and gets a commercial appraisal. The commercial appraisal, and I don't know if you've ever seen commercial appraisals, like 140 pages long. This thing's insane. And they comp it based on the net operating income of that thing, plus like some other factors, but like also comp it. And they also do some of the comparisons in this commercial appraisal were like other multifamily buildings down the road. Like,
and this was a single family home, or was it a multifamily?
It was a single family home, yeah, with an ADU. Anyway, they ended up getting the appraisal. It appraised, and they sold this thing, and they made tons of cash. I have reached out to my very, very local bank. I have a bank here locally, People's Bank. They're small, one branch. And he's told me that they would also, he said, if you were willing to sell your co-living asset, single family home, they would also, and I was willing to pay the $2,000 for the commercial appraisal, they would also use that as a real appraisal. So again, this is like Sam, you're getting Sam in fantasy world right now. Like imagine if all my single family homes were evaluated on the net operating income and I could sell $500,000 assets for $1 million. Like
crazy.
Dude, insane. What do you think as a lender? What do you think are realistic? And the only people I've ever heard say they would even consider this have been local banks, right? Relationship banks. Maybe I have my deposits with them and they're willing to take that risk.
Yeah. And I hear you. So there's a few comments here, right? Because when I talk to a lot of investors, even the investors hearing here now, I'm glad that I can just comment on this. What that buyer needs to be aware of is that they just entered most likely, and you correct me if I'm wrong, do you know if that's a 30-year fixed or is it got a balloon payment in a few years?
No, I don't think it was 30-year fixed. Good point. Good catch. Yeah.
A lot of people don't even know what 30-year fixed means in terms of like, what's the alternative? And so this is good to break into what are the alternatives to a 30-year fix. And a 30-year fixed note usually is there to protect borrowers. And usually these types of loans are not given to regular borrowers. So I want to say that the buyers also had a lot of assets. There was a lot of sophistication behind the people who were buying that asset, because the loan that they just entered into is a sophisticated loan, meaning that maybe it was like a 25 year amortization, and it probably had a 5 or 7 year balloon. What that means is that in 5 years, the entire note, maybe it's 700,000, right? And then they probably put 30% down. You're not picking that up at 20% down. So you're probably putting 25, 30 or 35% down. So they probably had a nice down payment, right? So that's other things that people don't consider, is that loan type is going to have a higher down payment than what you're normally used to. Your interest rate could actually be lower, right? And it's because in a few years that loan is going to be due, and they're going to ask you to refinance the loan, or you're going to have to sell the asset. So when I talk to especially like newer investors that have this mindset or belief that would be super cool, I remind them that it would not be super cool, because if something happens in a few years and you need to offload that asset and you just refinanced at a super high balance now, and your asset now is performing less than, well, then now you're not going to get the same value. You know what I mean? Or if you got in when rates were low, but then now a few years later rates are higher, if you have the same cash flow, or even if your cash flow went up, your value is going to be adjusted off of your net operating income.
You're
So
basically playing in this space of like multifamily loans.
multifamily,
Which
totally.
a lot of those guys are kind of effed or in a difficult situation right now because of rising interest rates.
Right. All the people that got into multifamily when it was 3% and got these massively high valuations, they were rolling in the Benjamins, right? Because they got these refis off these high valuations. They got all this capital. They reinvested that capital. That's called being overly leveraged, right? When you're just like leveraging to leverage to go and buy more assets. In theory, this is awesome, but it's just it's a double-edged sword. And the people have to know how to use it. It's a very sophisticated tool. I personally, I just like really quick, like an interest-only loan. I got into an interest-only loan myself. I'm okay. I'm comfortable with it. I understand what that means, right? But I'm not going to tell a new investor, hey, you can cash flow a couple $100 more if you get into an interest-only loan, right? Because that's not paying down the principal. And now, they could run into a different problem in the future if they have to offload the asset, and they're going to be like, Fernando, like I was never paying down the principal, and there's just, with more sophisticated lending tools, you need to make sure that the investor themselves understand what risks they're taking on.
Yeah, no, dude, that's a really beautiful way of putting it. I'm glad you're adding that perspective to my optimism. I think maybe my vision, my beautiful like fantasy world vision is like, okay, this asset class is growing. Maybe in 5 years, I package all my stuff up and I'm the one selling it to somebody like that, right? To a hedge fund or to somebody that is willing to take a more
sophisticated buyer, okay with that.
Exactly.
Right.
And now I'm selling a packaged product at a multiple that's much greater than if I just went through all of my homes and said, what's the comp value based on what all the other homes are worth in those neighborhoods? Like that could get exciting, right? Now we can exit $15 million and they can take the rest, right? I mean, that's what I hear you. You're saying it might be good on the sale part, but on the buyer or the refinance end of what we're talking about,
right?
Beware.
But totally, I think if you're selling, like if you have the opportunity to sell, like I think that's great. I mean, even on the refi, you just have to know what you're getting into. But on the refi side, I tell the borrowers or my investors, I'm like, you want to make sure that you're still buying this to cash flow, and so they're like, oh, my ARV is $800,000. Like, is this a good deal? And I'm like, you got to be, even if you're cash flowing well in co-living, if you get that high of an ARV, that means you're not going to cash flow once you take the money out. Like it's going to be harder to cash flow at such a high ARV. That sometimes investors don't consider. Buying low is great. Rehabbing, cash flowing is solid, but like you have to run your numbers at the ARV. And sometimes like if you don't got like a 12 bed, a 10 bed or 12 bed and your ARV's at 700, 800,000, you really need like a strong performing co-living property to cash flow at a $800,000 ARV, right? Versus I think mainly what we kind of play in is like 300 to 600 range.
Yeah.
Right.
Well said. Yeah. You're eating up your cash flow. So you've got to almost sell it to someone who cares less about cash flow, which, like you're saying, some of these richer guys, full circle, sell it to these guys that were telling you that $1,000 didn't matter to them because they just wanted to get in real estate, right? They just wanted to have their money.
And they have more capital. So they're okay putting a 30, 40% down payment. So if they're okay with putting a bigger down payment, or you're okay leaving money in the deal, then you're fine. Because you're right. If you're at 800,000 and you're at a 65% LTV, well, you're going to be fine, right? You're not trying to get to the 70 or 75 LTV. But yeah, that's a good point there.
We have to wrap this up mainly for time's sake. But I want to say this to the listeners because this has been fun. This has been one of the fastest. This episode has gone the fastest. And I would say we'd stay on here, but we got to do a part 2 to this. I think there's a part 2 to this. Because frankly, I have more questions for you, and I wanted to deep dive into like a little bit more of the strategies, getting deeper into the DSCR loans around co-living, which we did a lot of, but I think we could have gone even deeper. But I got to wrap up for time's sake, and today's a big training day for me. So I want to say, what's your vision behind this? What's your vision behind your company? What you're doing? That's number one. And then just follow up that with like, how do people reach out to you? How do they find you? If they want to do a loan with you, how do they connect with you? Share that with them, please.
We didn't even talk about rates at all. So October 7th, 2024, just really quick. So right now, rates are going to be between 6.5% and 7.5%. And that's going to be based off of like your credit score, what loan to value you're at, if we're using Airbnb or AirDNA or not. But just to tell people where we're at, like we are seeing rates in the 6s, which is sick. Like I'm doing a few loans right now where the rates are in the 6s, which I'm really happy about. So that's just something I do to share that's what we're seeing. You're right. We can get into DSCR loans a lot, but we can reserve that for later time. So my vision, man, this year we're probably going to close 120 loans or more. It's my first full year operating in business, and thank you. So grateful to just the partnerships, right? Like you and others, where you guys just give me an opportunity to share. And so for me, the vision that I have, I don't want financing to ever be an issue for an investor. And I had to solve a lot of my own problems when I was investing. So a lot of what drives me is when somebody tells me like, oh, I can't do this loan because of this. I'm like, I have a solution for you. Like I'm helping somebody get the money out of their self-directed IRA and using that money to get a loan right now. They just came from a lender who denied them. They came to me and we didn't even talk about this, man. Oh, shoot. This would have been huge value. But anyways, like how to get financing out of your self-directed IRA to invest. Like that's a strategy that I have for people, but they got denied by their other lender. And so that's just stuff like that drives me, that like gets me excited to solve that problem. Because it just got denied somewhere else. They came to me and I'm like, okay, well, what if we did this? I got on a call with their IRA firm and like we all solved the problem together based off the information I have access to and I know, and we're doing the deal. So that's what drives me. So in terms of the vision, I'd love to just be making a couple mil with the good team. I live off of becoming a better leader. So I know that to be a better leader, I have to go through a lot of like struggle, I have to be willing to endure. And I was just talking to my wife about this, like my monthly expenses right now as a business owner are I used to dream about making this money. That's what my monthly expenses are, right? I used to dream like my expenses are now, they used to be my income goal. And I'm sure you know what I'm talking about, right? Where your monthly expenses are like, dude, $20,000, $30,000 a month. And you're like, holy crap. Like I would have been fine just with that income. But in order to get to the next level, I have to be willing to take on that burden. Somebody said it beautifully. They said like, your dreams have to be big enough for other people's dreams to fit inside of as a leader. And I'm sure you're getting that too. Like you told me what's your dream for CoLiving? You want to help like, was it a 1,000 or a million?
1 million. Yeah.
1 million. Think about how big that
1 million rooms.
1 million rooms. That's a huge dream, right? But under that dream, you've got hundreds or thousands of investors that have their dreams that fit in there. So that's what it means to be a leader, dude. So I'm going to continue to grow and build on my leadership skills, partner, hang out with people like you that are doing the same thing.
Wow, man. How do people connect with you? What's the best way for them to reach you?
Best way right now, just you can text me or call me 626-714-2440. At the moment, I have a good team, so I still respond to all my texts and pick up my phone calls. So I think that's currently the best way of doing it. But I've got a lead loan officer on my team as well that his name's Jimmy. And he's been super cool in helping the business grow. And we have processors that help everybody. So I'm not doing everything on my own. But that's the best way to get a hold of me. On Instagram, follow me at It's Fernando Corona. It's actually here on my tag at It's Fernando Corona. And I got a couple of YouTube videos. Dude, I'd love to do a collab as well on some YouTube videos. How we can help the co-living community out.
100%, man. That's so amazing. I'm impressed with you. I'm impressed with your knowledge. Thank you for just opening. Thank you for pulling back the curtain and being so authentic today, man, in this meeting, in this interview, and just pulling back the curtain. We got real Real vulnerable. Great to hear your story. Great to know your story. I didn't know a lot of those pieces of your story, so this was really like kind of at the edge of my seat for me too for this interview, man. I really felt like you took us on a journey. God bless you. Thank you for your time. We'll link everything in the show notes, and we will 100% do a part 2 to this episode.
Thanks,
Thank you, Fernando. I hope that episode didn't disappoint you. It was so fun. We'll definitely do a part 2. Please share this with someone who needs this. Share this with someone that's along this journey. I love you guys. I look forward to seeing you soon in another episode. God bless.